Should I move that?
And we're recording. Kara was talking about something. What do you want to move, Kara?
Shocking.
Well, I just didn't know if, Scott, if you sit like that, then you're in here. But if you sit back, you're not.
You're going to be lost. So maybe we should turn it a little bit.
Do you want me to turn it over?
We thought we had this situated
I would
before we started.
just move it more towards me.
I am.
That's what
I'm doing.
That's what people want.
Oh my God. Good job, Kara. As she looks.
I mean, are we serious?
I didn't know it was recording.
It's recording.
Okay,
yeah,
okay.
No, this is great. I'm leaving it. I'm totally leaving it. That's awesome.
Don't care.
All right. So today we are talking. I got to get bigger stands because these. I might have to hold
Like
this.
a stack of books.
I know.
No, they don't go
They
up.
don't go higher. I need to get new ones. I need to get different ones. So we are talking about second mortgages today. And Scott Simpson with Entrust Mortgage, along with my work daughter, Kara. She is here with us. Going to chime in where she feels necessary. I'm going to work on those new stands. But I've encountered second mortgages lately, like a big one in a different way, and it's kind of put some things on hold as far as who is able to answer my questions, I guess you could say. And Kara had to take a phone call, so we're going to put her on mute.
Obviously, it won't be Kara answering your questions. So.
No, it's going to be you and I for the time being. Right. But second mortgages, Scott, kind of explain to our listeners and peers how second mortgages work in the lender industry.
There's a lot of different. You'll hear the term second mortgage, or you hear the term home equity loan. Those are the two different kinds of mortgages. But basically, it's just when you buy a house and you get a mortgage, it's called your first mortgage. It's just filed chronologically as your first mortgage. If you go obtain another loan or another type of financing, now that's your second mortgage.
Right.
Now, most people don't go get a third one, but in theory, you could have a third, fourth, and fifth. It's just filed chronologically at the courthouse with what liens are on the property.
And there's Brian Weather, folks. This is like
a revolving door.
It is a revolving door in here. Everybody wants to come and see you, Scott. You're so popular.
I guess so.
So who can supply the second mortgage now? Like, as far as I have a seller right now that's going to supply a second mortgage for some buyers, and I know grants sometimes are like City of Covington or Kentucky housing money, that kind of thing can be used as a second mortgage. Why don't you elaborate a little bit on that?
Any person or financial institution can be the second mortgage. When you mention your seller, a lot of people call it a seller held second. It's a private mortgage between the buyer and the seller that maybe they supply more friendly terms than they might be able to get at a bank, maybe help them qualify. So the seller's just like, instead of getting all their money at closing, they might just say, hey, we've got a separate agreement between me and you. You can pay me this amount of money every month or for the next 10 years or whatever it is, instead of paying the bank.
Okay.
And maybe that helps them get the terms better on a first mortgage or qualify for that product, depending on what they're doing.
Because it's not going to be the full amount of what the sale price is.
Correct. Yeah, the most common, like people used to hear about an 80-20 or an 80-10-10, and those are just percentages, 80%, 10%, 10%, whatever. And for most types of loans, people always thought if you put 20% down, then you don't pay private mortgage insurance or PMI.
PMI. Mm-hmm.
So, and a very common product is, for example, as we're talking, you might buy a house. You always need to get 100% somehow. A total of a loan and down payment is 100%.
Right.
So you might have let's say it's a $100,000 price. You get an 80% mortgage, first mortgage, that's $80,000. You put down 10%, then you would have a second mortgage for the other 10%. And your first mortgage is an 80% loan because they're only lending $80,000 of the 100.
Correct.
Then you have 10 from the seller.
Right.
10 from the buyer, and 10 from a second mortgage company financial institution, or it could be the seller.
Right.
It's just that. So, but as far as qualifying on that first mortgage, it's that 80%, and that might give you better terms, and that's maybe why you do it.
Gotcha. So, but a lot of people don't understand it's in sometimes some sellers, if they don't do their homework, they're not getting it either. You're second in line. So if this loan, if the first loan is defaulted, or if it goes into, foreclosure, and bank comes and says, hey, we're selling this and we want our money, you might not get your money back.
Correct. Yeah, you're like you said, your second line. Some people call it a junior lien, and you're behind. And just like in the financing world, there's senior debt, junior debt, whatever. It's all who's first, who's second, who's third, getting paid. So yes, exactly. If there was a foreclosure, tax lien, whatever
Taxes
it might be.
Go first, though. Yeah.
Yeah, taxes get paid. The government, if it's involved,
Government's got to get their money.
They're going to get theirs first. But yeah, let's say there ended up being a foreclosure, and it goes all the way to a foreclosure sale, and then there's a pot of money left over. Okay, first mortgage gets their money. And if there's nothing left over, you're that second. You don't get it. you don't. There's nothing there.
Do you really? I mean, that goes with any type of second mortgage, though, doesn't it?
Correct, and that's why generally, the terms on a second mortgage, comparing apples in the same interest rate environment, the interest rate on a second mortgage is going to be higher than an interest rate on a first mortgage. It's a more risky product.
Right, because they don't know if they're getting their money back.
Yeah, because they're second line. So because of that added risk, or maybe because there's a higher equity position they're in,
right,
then it's more risk. It's priced that way.
So do you suggest that sellers to get the deal done and to make sure that they're getting their full purchase price? I mean, to me that sounds pretty daggone risky. Do you really recommend sellers to put it out there saying, hey, I'll help you with finance?
No, they're not really that common, to be honest with you. I mean, there's nothing wrong with it, but it's in every situation's unique, everything, whatever. But in general, if I'm selling a house and I would want to get my proceeds or my equity when I sell my house, not collecting, $3 a month or $100 a month from the seller over 5 years because they couldn't get a big enough loan, or they couldn't qualify for a high enough loan, or whatever it is. There might be a reason where it makes a ton of sense.
Right.
But on most people, it's not something they want to go down because they don't want to be the bank.
Right. Well, very few people, I'm sure, could probably finance hundreds and thousands of dollars and, eat it if they had to.
Correct.
I don't know. That doesn't sound like something that I'm dealing with it right now, and it's how does that work when you have your debt to income ratio and there's another lien put on the property? Does the mortgage company kind of look at that and say, hey, whoa?
On any mortgage product that we deal with, I mean, there's always unique financing on commercial properties or maybe a business that might have different rules. But for your normal mortgage products that we deal with, your conventional FHA, VA, USDA, for your loans that we do, if someone has gets a second mortgage through the seller to cover whatever, yes, we need to know what those terms are and show as part of our underwriting package that yes, now there's a $25,000 seller held second, and it's got a 6% interest rate, and it's payable over X number of years. That payment's $314 and whatever, and that counts in their qualifying ratios just like if they had a car payment for that or whatever it is. So yes, we do need to document that because it's on paper, your sales price and your loan components, if you have a first mortgage, a seller's held second, whatever it is, down payment, it's all got to equal 100% of that sales price.
Right.
So there's not going to be a missing piece. You know what I mean? It's all got to come together and complete that puzzle.
So I think, correct me if I'm wrong though, but the grants like from, there's the city of Covington or like we're in Kentucky and the Kentucky State.
Right, Kentucky Housing.
Kentucky Housing gives the grants. Those usually are those really considered into their debt to income because they don't really have to pay it back until they sell the place, right? Or if it's within 10 years?
There's two answers to that. One's yes and one's no.
Gotcha.
The forgivable grant from the city of Covington that we're familiar with, it's a $10,000 grant that they give them. They can use for their down payment, use for closing costs, whatever. They file a second mortgage for $10,000 against the property. And it's forgivable 10% every year. So that if you live there 10 years, you never pay back a nickel. There's no monthly payment we use in our ratios because it's a forgivable grant. Okay?
Gotcha.
If you sold your house after 5 years, well, then you owe half of that grant money. So you would sell your house and you would owe $5,000 back.
Taken out at closing and
Correct.
Yeah.
The Kentucky Housing Corp, when their version of down payment assistance, and there's other versions of this down payment assistance, they do it. It's a second mortgage, and if you take the full amount, the payment's basically $100 a month.
Right.
Okay. So yes, we count that $100 a month into their qualifying ratios, and you do make physically a second payment. You have your first mortgage payment,
Right.
and then you have a second. You basically
Well, I have a client that
Yeah.
received that. Yeah.
you're basically they're letting you borrow your down payment or other money you need for the loan, whether it's down payment or closing costs or escrow items, whatever. They're basically giving you a loan to help you buy that house, and then you pay them back $100 a month until it's paid off.
Right. Okay. So it's a little bit different, folks, when you're on that second mortgage, when you're getting a grant or something from the state compared to having the seller put up the money for that second mortgage, because I don't know. The situation that I'm in right now, I'm very uncertain on how things are going to pan out, but I guess we're going to have to
You see how it works. But yeah, I mean, they as market trends change, sometimes they become more prevalent. Just like sometimes you hear about land contracts becoming more prevalent and all those things. Land contracts, when you talk about a seller held second, the land contract, same thing. It's, I'm buying a house off of you. We're not using a bank. Mm-hmm. You're the Bank of Claudine. I'm going to buy your house, Claudine, and I'm going to pay you this much money every month until it's paid off, and you just get your money $800 a month at a time until you get all your money, as opposed to I go get a loan, you get a check at closing, you're out of the picture now. You sold it. Now I pay back the bank,
Right.
the mortgage company.
So what do you prefer? What do you?
Well, us being a mortgage company, I prefer they get a mortgage.
Well, of course, but I mean, as far as like with a land contract and then doing a second mortgage, I mean, that's pretty much.
Yeah, what I'm saying, what I bring that up is the land contract is structured as the payment mechanisms would be very similar to a seller held second. Yeah, it's just you're limiting the bank institution
completely
of that. It's just an agreement between two parties. Lien can be filed, and then you have a mortgage between yourself and the seller directly.
Well, sometimes the seller's second is also called like a promissory note.
Yeah, you have a note and a mortgage, and the note is what makes the mortgage recordable to file the lien.
Kara, what do you think about second mortgages? You want to chime in?
Not really, but I like the conversation.
Valuable insight as always, Kara. Thank you.
I just like to listen.
Oh my gosh.
And walk around. As
I mean, you crack me up. It's
I'm working. This is time where I can do things.
No, I love it.
I like listening. I just don't want to.
Or somehow her phone is tied to her headphones and we hear the chiming. Or whatever
Do you
it is.
guys hear the chiming?
Yes.
Yeah.
Okay, because I'm like, I thought I turned it off and it keeps going.
Well, I thought the Pac-Man machine was still on. I thought it was hearing.
Nope, just me.
It's just Kara.
Just me.
Oh,
Just showing you guys that I'm actually working.
This might be the shortest podcast that we've ever had. I mean, what other? I mean, 2 cents because you put in there, Scott. Yeah. Because I mean, we haven't really. Yeah. I thought there might be more to talk about.
Well, the other part I would branch that into a little bit is it's funny how people don't think certain things are second mortgages or whatever, or you hear the term home equity loan all the time.
Right, right.
And there's times where getting a home equity loan is a great idea, and other times it's not. It all depends on someone's situation, obviously.
Well, when would be?
When would be a good time?
Yeah.
Good question. We'd leave that in there. No, but let's say, like right now, there's a lot of people that bought a house during COVID. We'll just do it because it's recent. Or let's say you had a really low interest rate on your mortgage, and you wanted to borrow access. You have a lot of equity in your property. 10 grand, 20 grand, 50 grand, whatever it is. I want to redo a deck and whatever, or maybe I want to take a great trip. Maybe I want to pay for kids' college. You want to
pay off your credit cards or do whatever you need to do.
You want to access money from the bank of your house. Your house is, you got a couple $100,000 of equity sitting there. How do you get it? Well, I don't want to refinance my mortgage that's at 2.6%.
Right.
Go take out a new first mortgage, pay off my 2.6, but now I'm going to get 6%.
Right, right.
Just because I want to get 30 grand. Leave my 2.6% mortgage alone. I go get a second mortgage, a home equity loan.
Right.
And yes, I'm paying a little higher rate than I would be.
But it stinks, and I get. I'm sorry to. Well, I'm not sorry to interrupt you, but I'm interrupting. But just that's my daggone money that's in the house.
Yeah, but but if you want to borrow it, someone's got to lend it to you, unless you're going to go
Sell the house.
pay for something with,
Right.
what are you going to give them, a piece of paneling at a time, or, take your kitchen cabinets?
I get it, but it's, you'd be surprised how many people, well, that's my money. Why do I have to go? And I'm like, well, because it's not liquidated.
Exactly. I was going to say, you
liquidated.
might have a giant jewelry collection, unless you're
Right.
going to go barter with somebody at a pawn
Right.
shop or whatever. Someone you're going to trade that for a car. You have to sell your jewelry, turn it just like you got
to sell your house in order to get
Or if you're not selling it, you're going to go borrow against it with a loan.
Correct. And so, but you could only borrow up to 80%, correct?
You can go. There are actually some that will go 80. They used to go back in the day, easily get 100%. Most lines of credit max out around 85.
Okay.
Depending on your credit score, there might be a couple places to go 90, but the most common is 85. And how the math works is, we get asked this all the time. People don't understand. I owe X. How much my home equity loan can I get? And the simple math is, they come up with a value for your house, whether it's an appraisal, an online estimate, something. There's going to be somehow a value placed on your house. And just to make all the numbers easy, let's say you owe 100 and your house is worth 200, and you get approved at 80%. You would take a $200,000 value times that 80% that you're approved for. That's 160. That's how much in loans you're allowed to have. Well, you already have a $100,000 loan, so that gets subtracted. Now there's room for a $60,000 HELOC, home equity line of credit.
Right.
And you would have a $60,000. And home equity loans work like I explained, like a glorified credit card against your house. You're approved for a dollar amount. You're issued a home equity loan. In that example, you have a $60,000 line of credit you can use. If the first month you only borrow $10, you get your bill in the mail, you only owe interest only on $10. You're not making a payment based on the 60 you're approved for.
Right.
And you'll see
It's whatever
people
you take out.
Correct. And you can re-access it.
What
So-
if your house is completely paid off?
Same. Then when we talk about chronologically with mortgages being a first or second mortgage, you can either go do what's called a cash out refinance, and you get a first mortgage. But let's say that would be your best terms if you knew you wanted exactly $50,000, not a penny more, not a penny less, and you're going to use 50 grand. Then you start paying back 50 grand. Okay, it's gonna be a fixed rate. That's the advantage of getting a cash out first mortgage. Fixed rate right now, my payment's X, it's paid off in 10, 15, 20 years, whatever. But let's say you didn't know how much you wanted to spend. Or you might be doing a big addition, you don't know. It could be 40 grand, could be 80.
Go over budget and you need
Right.
a little bit more.
Yeah, or people sometimes want to do it for a safety net. Hey, I got a ton of equity. Like I said, my house is paid off. I don't need the money today, but I know my credit's really good today, my job's really good today. I want to go get approved for this line of credit right now. I'm going to go open up a $150,000 line of credit against my house in case I need it. Or I might want 10 grand today, I might need 20 grand next year, I might need
I mean, what if you lose your job and you
So go
you
get,
need something?
if you have the ability to open that account now as a safety, great, doesn't cost a lot. Now you've got your approved line of credit, and you can use it as you want, and then you only pay back what you borrow.
But you do have to close that out.
Yeah, how long does it last?
Yeah, you do have to, when you sell, because I had a client that had that left open.
We'll come back to that. Let me
Okay.
hit that.
Okay.
Yeah, how long can you draw on it? Most of them, every bank's a little different, but the rules are there's what's called a draw period, and how many years you're allowed to access this money. Most of them, some are 3 years, some are 5. I heard of some going to 10. The most common are on a 5-year draw period. And you can, just like a credit card, let's say you had a $50,000 home equity loan, and the first month you go borrow 50 grand, and then you pay it back. Maybe 3 months later you can borrow that 50 grand again and pay it back. Maybe you're flipping houses. Maybe people do it for the business. They go to car auctions. They go to do whatever. It's like a credit card. You max out your credit card. If you pay it off, you can use it again, right? That's how that works. So you would be able to draw on it. Let's say it's a 5-year draw period. You can draw that money, pay it down, draw it, pay it over that 5 years. After that, you no longer draw on the money, okay?
Got to pay it back.
It enters into a prepayment phase, or a payment, prepayment schedule, or what do you want to call it. And usually it's an interest-only period, maybe for the first 10 years. And then at that time, it becomes fully amortized for the next 10 years or 20 years, or how many years you took out the home equity loan. And fully amortized means, you might make interest, you can make extra payments, but you're only required to make interest-only payments for maybe that period of time.
Okay.
And then after that, the bank's going to say, hey, when are we going to start getting our principal back? Then you start making payments so that in 10 years, this is paid off.
I gotcha.
And a fully amortized loan, it's kind of like a car loan. If you go buy a car, you know, it's a 6-year note. Hopefully, at 6 years, that last payment should pay off your car. I mean, it's
Right.
every month there's principal in there to pay it off in that period of time.
Right.
That's what happens at the end of the home equity loan period. Is after that interest-only period expires, now you got to start making payments to make sure it's paid off in that period of time.
Right.
And to
Okay.
go, about it paying it off when you sell your house, you have to pay off.
Well, even if you didn't borrow on it, you still have to close it out.
Because the collateral is what? It's that house you're selling.
Right.
Yeah.
And then it's because my client forgot to tell me that she had that.
Yeah.
And I'm like, whoa, what is that?
And it'll come up. Yeah, it'll come up.
Your house is paid for, but there's a lien on it.
A lot of it's amazing how many people don't think that home equity loan is a mortgage on their house. I've had people say, "No, it's not tied to it's not my house." But they use my house for collateral.
Or they get mad because they're like, Claudine, why did I have to pay closing costs? And why did I have to do this and this and this? And I'm like, because it's like you're buying.
Or people think it's like a negative connotation, like, oh, they went out and got a second mortgage, like they had
Right.
financial problems. That doesn't mean you have financial problems
Correct.
because you got a second mortgage.
Right.
So people, when you ask them about it, and I know I'm stereotyping here, but a lot of people we talk to, I'm like, oh, is that a second mortgage on your house? And I see that on your credit report. No, that's just a loan.
Yeah, I needed it to help my parents out. Well,
Yeah.
that's what that is
it's
there
fine.
for. Right.
But when it's coded on your credit report as real estate, it's a real estate loan. It's a mortgage against. They probably filed a lien against your house. Most of them, why wouldn't they?
Well,
So-
they want their money back.
Yeah.
Right.
So yes, it does have to be paid off and closed when you sell your house. And on that, we've had people, you actually get a checkbook. Most places will give you checkbooks, and we give you like a Visa card. There's different ways you can access your money from your equity loan. We've had people sign a paper. Let's say you're selling your house and you have an equity loan. The title company will get a payoff on your equity loan just like they would your first mortgage. But they don't know. Maybe that morning you wrote a check to somebody for $3,000. It hasn't gone through anywhere yet. And they go to pay it off, and then there's this $3,000 check
Like,
or
wait
whatever.
a second, what is this? Yeah.
So the seller will sign paperwork. Hey, this is my payment, payoff. But if something else comes through, I'm liable for it.
Right.
You sign that as to hold harmless the title company or somebody else. That if you if there's transactions that haven't posted yet, please let people know because it's going to be a problem.
Yeah, well, I mean, they think it can look like you're stealing.
Yeah.
And I've had clients who buy luxury homes, million plus, that they would do. They'll take out 2 mortgages for that.
Yeah.
Do you want to elaborate why people would do that?
Yeah, well, if you're talking about like staying away from jumbo financing, probably.
Correct.
Yeah. So the conventional loan limit changes over time. So let's just say right now it's $700,000. Doesn't make up the number. So let's say you want to finance $900,000 on this $1.4 million purchase. Rates on a jumbo mortgage, which again are above what are called a conventional loan limit, they have higher rates because it's a riskier loan.
Right.
So to stay away from that, people might say, I'm going to max out the first mortgage to stay under a jumbo. I'm going to borrow $700,000 even. We'll make it the math. I'm going to take out a second mortgage for $200,000 because maybe that blended rate is better than what one big jumbo mortgage rate would be.
Yeah.
It's not always an extreme example, but maybe getting a 6% loan and an 8% loan is better than getting all of it at 7.8. That kind of thing.
So, in a lot of these, on these second mortgages, do they have prepay or like penalty for paying it off early, or
Generally not, but they might have an early account closure fee, whatever it is. Most of them are not.
You're getting penalized for paying off your debt.
If you're debt early. Most of them, yeah.
Well, because the bank wants to make money. I mean, everybody's then,
Yeah.
it's like you get this credit score and you're like, shit. And then you want to pay it off because you want your credit score to go up because maybe you need to go buy a new car or maybe you want to go buy a boat.
Yeah,
Who knows?
generally not. But, I've seen some places that say if you close this in the first 6 months, we're going to charge you a $99 closure or whatever it is. But that's, again, bank by bank specific. Usually nothing's out there too prevalent or too punitive to do that.
Gotcha. Well, now it kind of makes me want to go get a HELOC, Kara.
I know. I've been thinking about it for years.
I know. It's good.
There we go.
You and I
I
sound.
want my pool.
I was thinking the same thing.
Does either one of you know what HELOC stands for?
Home equity loan of credit.
That's pretty good. I didn't know.
Bang, bang. You've taught us well, Scotty.
I know.
I love hearing you talk.
I know. We kind of sound like The sisters from Saturday Night Live. With
Why are you whispering like
I don't know, sweaty balls. Sweaty ball sketch.
That's before Kara's time.
I know she's got to know it.
Yeah, I
You
know it.
right?
If she watches like the highlight reel of Saturday Night Live, then she might
Yeah,
know
well,
what that
during
is.
Christmas time, they always play it.
Yeah.
They always play the skit,
Alec
right?
Baldwin.
We could just pull it up on there. Or I could pull it up.
Yeah, we could. I mean, it is pretty funny.
We know
Not
if you
that
put
we
it up
need
on
to
your phone,
repeat
it'll come out. But
It's where the sweaty balls are realistic.
this
I don't
one-
think I want to play it anymore.
Probably
Play it
not.
after.
Probably not.
Yeah.
Let's not do that.
Let's not.
No, but well, Scott. I mean, do you have anything else to add into this? And Kara, you too.
I don't know. No, I just think most people don't think second mortgage has a negative connotation. A second mortgage is just another
Folks,
loan you
it's
got
there-
against your house.
Well, and it's developed for a reason.
It's a financing tool.
Yeah.
It's a great product for some people, and it's a terrible product for some people.
Oh, elaborate why would it be a terrible product? Let's go there. We haven't
Okay.
talked about that.
Well, let's say hypothetically, you go get a maximum loan to value, whether it's 85%. Maybe you find a place that will lend you 90% of your home's value.
Mm-hmm.
The higher that goes, the higher your rate's going to be. Just like we talked about, every time a loan becomes riskier for whatever reason, just like people think if they have a lower credit score, they're probably going to pay a higher rate or higher fees, right?
Right.
Same thing. The more of the equity you're borrowing, it becomes a riskier product, so you're going to be priced accordingly. So let's say properties are skyrocketing. Let's say you find someone, a bank, and they give you a really high value on your house. Maybe they don't do a full appraisal. Maybe it's some electronic model. Maybe it's a Zillow estimate. Who knows how accurate these are. So maybe they're giving you, okay, yes, you can borrow an extra $150,000 if you want to. And maybe that maxes them out. And someone's like, don't control their spending. Maybe they, I can get a $150,000 line of credit. Awesome. I might need to sell my house in 2 years, but I don't care about that. I just want to get, right now, this bank's willing to give me a $150,000 credit line.
Right.
And some people, they have access to 150 grand. They're going to spend 150 grand.
Yeah.
And let's say 2 years from now, when someone gets transferred, they need to sell their house, whatever happens.
And they have no
And
equity in their
yeah,
house.
maybe values, maybe they do go down for whatever reason, temporarily.
Let's hope not.
I know, not all values never go down. No, but let's say, maybe they're in a unique situation. Maybe they're in a condominium association that has legal problems. Maybe they're in something that all of a sudden people don't want to live in that area. Whatever,
Right. There's always different factors
And
that
now
can come into play.
they want to sell their house, and they can't even get what they owe. Or maybe they can only sell it and break even, but they have to pay settlement costs. Now they thought they'd walk away with money, but now they don't have anything because they
spent it.
accessed it and used it all. Like you said, they liquidated their equity, right?
Right.
So that's the one thing. If people are responsible with it, I think, like anything else. Just like people getting credit card debt. A credit card's bad? No. But if you have 30 of them and owe 200 grand on them, then they're
Right.
probably not good.
Right.
So
Right.
that's where I would think if people have to understand.
Oh, that makes me. Ugh.
I know. I would just puked.
Yeah.
But
I would die.
when some people don't think it's tied to their house, they might think, even though they're signing papers and they don't read, they don't listen, they don't whatever, and they borrow that 150 grand, they might just think, well, I'm going to sell my house, but I still have all that equity. Not knowing that 150 grand is tied to the house.
So a lot of people, and I'm just asking because I've been asked this. Do they have to use the same lender that they used to buy the house to get their HELOC?
Absolutely not. Absolutely not.
Yep.
And
Because
there's
you could get better rates somewhere else, and
Possibly.
it just
Absolutely. And just like when we talked earlier about using a second mortgage to buy a house, maybe to avoid PMI or whatever, whether it's the seller held second, whatever. A lot of times the acronym people use, they'll call it a piggyback loan. Like at the same time I'm buying this house, I'm gonna have two mortgages closing. My first mortgage and the second mortgage, maybe to help me finance this better. Sometimes that second mortgage would be at the same company. They have a Bank A first mortgage and a Bank A second mortgage. Or maybe not. My mortgage is with this bank, and my second mortgage I'm closing the exact same day is with this other institution that maybe specializes in doing
HELOCs
second
or
mortgages
whatever.
on purchases.
Right.
So that's called a piggyback at the same time. But no, they do not have to be with the same bank. If you have a first mortgage right now and you want to get an equity loan, you don't have to use who your first mortgage is with. You can call anybody else and get that.
That's good to know, folks. That's good to know. You can shop around. You're not stuck, and it's just like with refi, correct?
Correct.
You can go to a different lender or mortgage broker, such as himself,
Right.
and see what the rates are. See what they can do.
Absolutely.
And would you consider that a soft pull so it doesn't affect their credit?
You can do a soft pull, yes, at any time to qualify, look into options, and have no effect on your credit. Absolutely.
Nice.
You
Nice
never
to
have
know.
to. You're never tied to a certain company. And when you do have a mortgage with a certain company, it's called your loan servicer. A lot of times people will get bombarded with solicitations from
Right.
said company because they're like, "Hey, we've already got your loan. This will be easy." And some people think it's easy.
Or like,
Maybe
we're
they-
offering 5.5% for
but
you
maybe
to,
the rate, but maybe the rate's not as good, but you think it's because it's my same company, it's better. Just always look around like anything. Whether
Shop,
it's first mortgage,
folks.
second mortgage, at least talk to people, get some ideas.
And we need to get that poll in before next summer.
Poll.
Pool.
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 God, I
from
was
a
like,
party.
geez.
We can make it a pool party.
We were going to do a
Thought you
GoFundMe.
were-
I was talking to all your friends.
Supplementing your income somehow.
We were going to do a GoFundMe because it was hotter than 80s.
I know.
It was so
you're-
The
freaking
party that you
hot.
did not come to, Scott.
I never got an invitation.
Oh my God.
Can
Here
I
we
call
go.
bullshit?
Yeah, call bullshit.
Bullshit.
Never knew about it.
Bullshit.
Lies. I even text you the cool invite that ChatGPT did.
That
for
was
me.
a mass group text to probably everybody in
It
your
was to
phone.
you,
know what, quit-
Jackwagon.
quit.
You can. There's
feeling sorry
technology
for
nowadays.
yourself.
Just like
No sympathy over here is given to you.
just like. Do you think every email you get that says "Dear Kara" that someone just typed that out? Or you
I
think
totally
maybe-
didn't put "Hey Scott," but I said I followed up with you like 3 times. Come to my freaking
mean-
party.
Is Kara aware there's email campaigns that you can just?
We do them all the time.
I mean, I'm not a tech
Kara's
person,
totally
but
aware of emailed campaigns.
I mean,
Everybody
I'm not
knows
a tech
that.
guru, but it'll say insert name here, and it pulls the name.
Oh my God.
It's not.
We're
she goes,
so
oh my God!
getting off track.
Home Depot sent me a personal email.
Oh, it's just like somebody liking your message on Facebook or Instagram that you think is somebody famous, and it's just like there's 20 million accounts that have that
Seriously.
name.
Yeah.
That happened to me. I'm like, oh my gosh, so and
Oh my
so
God.
liked my stuff on Instagram.
Oh, look at
And I looked-
Saks remembered my birthday.
Yeah.
And sent me a coupon.
Yeah, yeah.
And they
I
said,
know.
"Happy birthday, Kara."
We like to dream,
Hey
Scott.
Scott, you're personally invited to my party next year.
We'll see.
Hey, we got to record it.
Right.
It's-
What?
Yeah.
What day?
I'm not saying that on live video now.
It's a July 4th party. I'm assuming it to be
Well,
around July
yes,
4th.
but we're not going to say what day because
We're
I
not
mean,
asking for your
just-
address. I mean, I could put, whatever.
But we're all investigators sitting here, and if we can find where somebody lives,
yeah, I mean,
a lot more
well-
people can't do.
I know.
Just, it is public record at the PVA for everybody who wants
that.
to know.
I know, but the
But
best
I've
part
never
about
s-
my address is it doesn't go all the way to my house.
True that, and I haven't said
So if you
really
do
your
that,
name
just-
or last
just
name on.
Follow the road
on
and
here,
the driveway
so.
until it stops.
No, I have
Okay,
said yours.
skip all this.
Okay, we're
If they
gonna
look on your
wrap this
Facebook,
up.
since this party was so great, I'm sure she put pictures on Facebook.
I haven't had a chance to post
So
anything.
there might be
Forgive me,
images
not
of the
really, me either.
house, the yard. People might recognize where it is.
My free time is going into this, and
I'm just gonna be quite honest. If anybody else shows up, it's a really fun time, and I probably
needs the pool.
need the pool, and I probably won't remember.
Well, how about charging an admittance fee? So
Okay,
you
so if you just show up, you have to bring a
have to bring $100 if you want to come.
yeah.
Why not?
Not for everybody.
You're charging
no.
$100 to go to your July 4th
Yeah, for
party?
people
What
we
is
don't
going
know.
on?
For the people we don't know, if they just come in off the streets, then it's $100.
You think they're going to give you $100?
You think I
Well,
care
we're not
if they
letting-
give me $100
No.
that night?
We're not letting them in. We're not letting them in
They
if they
could give her
don't.
Monopoly money. She'd be like, holy shit, this is great.
That night I would be like, oh my god, I just got $1,000.
Well, it depends on what time of the night that you're getting $1,000.
So it sounds like there might have
shit.
been a few adult beverages at this party.
Maybe.
What we're saying.
Maybe.
Well, any old who. I'm going to circle this back
Yeah, circle
around.
back, finish up your
Well, we're gonna finish up the podcast. We got to work. We got other shit we got to do. Anyways, thank you, Scott. Thank you, Kara. Again, talking about second mortgages and HELOCs, and
I'm going to say hi to Jeff.
and
right
then
there.
Jeff Simpson in the background over
Jeff
there.
Simpson?
Yeah, we call him Jeff Simpson.
Oh.
No, Jeff Taylor. Sorry,
I have a brother named Jeff.
I'm teasing. Anyways, I appreciate y'all's time very much so. And until next, I'll think of something we can talk about. But my next podcast is going to be about dogs.
Dogs?
Dogs. I've got some couple people going to come on and talk about puppies. You'll be there for that one? Yes.
Interesting.
It's going to be Friday at 1.
Are you going to have guest dogs there? That'd be a good idea.
No, Bart wouldn't like it. Bart would get a little ticked off.
You could tag team that with maybe Kim and her rescue thing, and you could help us with dog rescues.
She is going to talk, but that's not who's coming. This is somebody else. But yes, so any old way, I want you to turn in because we're going to talk about puppies next time. But Scott Simpson, thank you. Kara, thank you. And until next time, we'll talk to you later.